Good morning, everybody, and welcome to our latest Meet the Management podcast. My name is Marc Ashton, and great to have you guys all joining us again today. Today, we're talking a topic that's actually quite close to my heart. It's the subject of EasyProperties. It's the fractional ownership model that's been introduced by EasyEquities. For those who are not familiar, EasyEquities has arguably been the most disruptive force in the retail investing environment in South Africa, probably over the last decade. And, I've always had this fascination about EasyProperties. What is it? What's their goal? What's it like to actually run a deal through the platform? And to answer those questions, I'm joined today by EasyProperties CEO Rupert Finnemore. Rupert, thanks very much for joining us.
Thanks for having me, Mark.
Well, let's get right into it. Maybe before we talk about EasyProperties, a little bit about yourself. What's the background, who you are, and how did you get into this industry?
I've been in the property industry for 25, 26 years. I've obviously been with the EasyEquities group about 6 years or so, and I spent a large part of my property career at Pam Golding Properties. Started off, interestingly, opening up black-owned Pam Golding franchises in all the township markets. That's where I cut my teeth in the property game, and then had a variety of roles in the group. And kind of senior exec roles. I was the regional MD of Gauteng when I left. So I've been in the property industry for a long time. And before that I was an English teacher. I studied teaching originally. I taught for a few years here in Johannesburg and taught in London for a couple of years. I think the abuse we suffered as teachers in London, some of it physical, I'll let you know, put paid to my teaching ambitions and made the transition into the property space.
Fascinating background. I think it's such an interesting way because we're going to talk a little bit about English and communication and stakeholder engagement, all one of some of the topics we're going to be running through today. But maybe my first question is, what were you trying to actually solve for when you launched EasyProperties?
It's very simple. There are a whole lot of friction points when it comes to investing in property for a large amount of people. Those friction points are things like lack of access to capital, lack of access to finance, lack of access to opportunity, which is obviously a really big one. And EasyProperties set out to solve those. It's a word that gets bandied around a lot within the Easy group, but set out to solve that and create more democratization and access to property investment for the EasyEquities community. Interestingly, it was a product that actually was born out of the EasyEquities community. Charles and Almira at the time, they sent out a survey to the Easy base asking what kind of other products and assets would they like to invest in. There was a massive response to that survey, and overwhelmingly the response came back saying that people would like to invest in property. And so EasyProperties was born out of that. And the idea was to solve all of those friction points through a fractionalization process, through crowdfunding, trying to create more access.
And do you think you guys have been successful? I always find it quite an interesting model. It's one thing to buy a share on the JSE, very different to buy a share in a property development.
Look, I think we've been very successful by a whole bunch of metrics. We are closing in on around about 200,000 investors now. So from a fintech stroke proptech business, EasyProperties is probably second to EasyEquities by investor numbers. We have bought as a collective around about 550 million rands worth of property over the last couple of years. So that is a number that we're actually really, really proud of. If you consider a REIT or some of these listed property funds and stuff, 550 million rand doesn't compete to their numbers at all. But if you consider that our average investment size is just shy of 1,000 rand, then 550 million rands worth of property is a massive achievement. So it's a number we're really proud of. Obviously, are there areas that we could and should improve? Yeah, absolutely. But I think on the whole, it's been really successful.
Maybe just take us through what a deal looks like. So I often talk to the retail investors and they say, well, I've kind of bought into a property development, but I'm not really sure how it's structured. There's obviously three stakeholders as I see it. There's the developer, there's the retail investor, and there's EasyProperties. Maybe just take us through how that dynamic kind of is put together.
Starting at the beginning, we are inundated with property owners, developers, shopping center owners trying to bring deals to EasyProperties for a number of reasons. Obviously, we provide opportunity to raise capital and do sales, but potentially we also offer through our base, if you think about a shopping center, investors who are also potential clients of those shopping centers. So there's a lot, but the property owners bring us a whole lot of investment opportunities. We've got a team here that assess all of those opportunities. We probably put on 1 in 5, 1 in 6 of these opportunities. How it typically works is I will then start negotiating with the developer. In this example, we'll negotiate the bones of a deal. Obviously, the nice thing about it is that from a collective point of view, because we are buying multiple units, we generally are able to negotiate really good deals and discounted deals for our investors. We negotiate a deal. In theory, I then take this deal to the investment committee of EasyProperties, which is made up of Charles Savage, who's the CEO of Purple, Gary van Dijk, who's the CFO of Purple, Sasha Graham, who's the head of legal, Jamie Levine and Andrew Hartog, who also were part of the original founding team of EasyProperties and got really deep property experience. I'll take that opportunity to them, and it either gets a thumbs up or a thumbs down. Once that deal gets a thumbs up from the investment committee, we then sign an offer to purchase with those developers, subject to raising the finance. At that stage, we set up an SPV that will house that particular investment. We put a prospectus together. That prospectus goes off to the CIPC and gets approved, and then the property opportunity comes onto the EasyProperties platform. We obviously raise money via an IPO process. So if we're looking to raise 10 million Rand to pay for this collection of properties, we issue 10 million shares in that SPV at 1 Rand, and that's how we solve the access point of view. Like literally you can invest in any of these things for as little as 1 Rand. As soon as we've raised the 10 million Rand that we need, the deal then with the developers becomes non-suspensive because obviously we've got the money in the bank. At the end of the IPO period, we issue the shares out to all of the investors, collect the money, and then we pay across the money to either the transferring attorneys, or in most cases, and then a normal transfer process happens. The attorneys transfer the properties from the sellers into the SPV, and we take ownership of those properties. At that point, obviously, we rent out the properties. It might come with a rental guarantee, or we might rent it out into the open market, and we collect rent, pay dividends, in proportion to the people's shares, and generally manage those units, maintenance-wise, tenant-wise, occupation-wise, collections, all of that. But in a nutshell, that's the process.
So one of the reasons I find EasyProperties great, and I actually use it for my kids quite a lot, is actually there's an education element to it. What is actually goes into buying a property. I think there's a lot of aspirational elements to I'm going to be a property owner, but very few people appreciate the actual return on investment, what the rental will be. And one of the things that always struck me, and I mean, I know that prospectuses are often taken with a pinch of salt, but one of the things I often ask guys is, have any of you actually read the prospectus? Because they've had this expectation the property is suddenly going to jump up in value when it comes online, or the development's completed, or they're going to be getting 10, 15, 20% dividends. And so, but have you ever read the prospectuses? And my question to you would be, I mean, do you think that it's one of those elements from an investor education perspective that investors don't spend enough time looking at those prospectuses to kind of temper their investment outcomes and their decisions?
Yeah, it's interesting you say that, and obviously you get kind of feedback directly from your community. That prospectus is an incredibly important document. I mean, it serves a number of things. Obviously, it sets as a starting point, it sets out the offer to subscribe for shares in this SPV and the investment. It's got all sorts of legal and regulatory kind of frameworks within there, but as importantly, it also sets out the risks associated with the investment. It sets out the assumptions that we've made in setting this investment and putting it in front of our investors. It obviously has a whole lot of financial models, and within those models, it's got all sorts of projections and assumptions that we've made around those projections. It gives information on when we foresee and project to have the first dividends being paid, depending at what stage the property is under construction or if it's completed or whatever. So it's a 74-page document. It's a regulatory requirement for us to, make an offer out to the public to subscribe for shares. But from an investor point of view, it's got a lot of information in there that guys really should look at from understanding what the offer is. When I was reflecting on one of your questions earlier, I think therein lies an opportunity for us to improve on that communication. Obviously, all of that information is contained in the prospectus. I also, for one, sign all sorts of insurance policies and life insurance policies and all of that jazz without actually reading all the documentation because, I think a lot of us do those kind of things. But on the EasyProperties platform, we do set out an investment case. We set out some of the marketing blurbs and stuff like that. And I think there's probably an opportunity for us to improve with putting that information in maybe a more digestible format in some of those sections on the platform. If you're saying that a lot of people don't read that prospectus, it's really important information.
And maybe last question from my side, learnings. You guys have been in the market now for a couple of years. Learnings that you could take away from it?
The learnings have been steep. I think launching any new business, the learnings are steep. I think launching a business that is a disruptive business, the learnings are even steeper. Yeah, lots. I mean, I'll highlight a couple. I think one of the learnings maybe is around that prospectus and communication. One of the major learnings, which I don't think we've quite got right yet, but need to keep improving on that, is EasyEquities was launched, and a lot of investors get used to the speed of investing in a liquid share and the returns around a liquid share. Property is not that. Property is a medium to long-term investment. By its very nature, property is an illiquid investment. We've tried to discourage people from putting short-term cash into these medium to long-term investments. We've often said, please don't put money that you need for school fees next month into EasyProperties, because property isn't an illiquid investment. But I think there's some learnings around that there's still perhaps some friction between expectations of investing in equities and investing in properties. One of the major learnings is the structure that we've used. We took the decision right at the beginning to invest via an SPV structure because the sense of ownership is a lot closer when you own shares in a property company that owns the properties. But now what we found for ourselves is we now have to administer 50 companies. And from a regulatory point of view and AGMs and audits and just general administration, we really have created a rod for our own back. I think if we had done one of the more sexy now, like the tokenization things, back 6 years ago, tokenization wasn't quite in vogue as it is now. But that would have been a lot easier for us to administer. There's certainly a learning there. And I think, investor communications, I think that's a learning as well. The other learning would have been to try and get more diversification from an asset class point of view earlier in the kind of process. My background was residential property. The two other co-founders' background was residential property. And so by nature, we've just got a focus there. I think if we had all come out of a commercial background, we probably would have had a higher commercial property offering. But it would have been good to try and offer greater diversification earlier on, which we're doing now, obviously, through the retail opportunities, student accommodation, offshore, some of the industrial properties. Yeah, another learning there, I think. There are tons. We could carry on all day.
It's a fascinating story and one I'm genuinely interested in. I think it's such an interesting innovation and disruption in the property market. Lots of learnings. Like I said, I give it to my kids to play with as well. Rupert, that's all the time we have for today. I just want to say thank you very much for joining us and looking forward to following up on the story.
Thank you, Mark. That was great.
Ladies and gentlemen, thanks very much for joining us on this Meet the Management podcast. Looking forward to our next interviews. Follow us on meetthemanagement.com and LinkedIn. Thank you.